CGGR is 124% crushes IUSG's 114% over 3 years, but that 10-point lead doesn't tell you about the downside pain ahead. Now let's shift gears and look at CGGR's pulling ahead with a 10-point lead. That's real cash staying in your pocket on every dollar you invest. But here's where it gets interesting. Over 5 years, IUSG edges out CGGR by 4 percentage points, a modest lead that reveals how close this battle really is. In plain English, think of these two funds as race cars. Both finished strong, but CGGR accelerated harder recently, while IUSG maintained a steadier pace throughout. Different strategies, different speeds at different times. IUSG's 97% return over 5 years shows its real strength. Consistency matters way more than short-term wins here. Here's where the story takes a turn. CGGR's 93% return trails by just 4 points, a surprisingly narrow gap that catches most investors off guard here. Let's break this down further. CGGR crushed it with 124% gains over 3 years, but momentum's shifting now and changing the competitive landscape entirely. In plain English, think of IUSG as the marathon runner with endurance. Steady gains over years. CGGR's the sprinter, explosive short bursts. Your investment timeline decides which strategy actually wins the race. Now, for the real question, IUSG's 114% over 3 years is solid growth, staying competitive even as CGGR started pulling ahead in performance. Let's dig into the details. Over the past year, these two funds ran neck and neck. IUSG edged ahead at 22%. CGGR close behind at 20%. Here's where things get revealing. A 2% gap over 1 year, that's basically noise. In the short term, these funds move almost identically together. In plain English, here's the deal with short-term returns. Over just 1 year, both funds finish neck and neck. Like race cars on a short track, you're mostly seeing luck, not driving skill. But wait, there's more to the story. Raw returns look impressive until you factor in the stomach-churning volatility you endured to actually earn those gains. Here's the thing, though. CGGR's sharp ratio of 0.7 beats IUSG's 0.6, meaning you're getting better returns for every unit of risk you take. Let's take a closer look. A 0.6 sharp ratio means you're getting decent returns, but riding through more bumps to get there. Not ideal when downturns hit. In plain English, the sharp ratio is like an amplifier knob. CGGR found the sweet spot, delivering solid returns without cranking up the noise. IUSG turned it too high and got distortion instead of clarity. But that's not the whole picture. Both funds deliver identical risk-adjusted returns. At 1.3, you're getting the same efficiency whether you pick CGGR or IUSG here. Let's see how this plays out. Both funds hit identical 1.3 scores recently, so when it comes to managing swings, they're neck and neck now. Here's what really matters. CGGR's Sortino ratio of 1.0 beats IUSG's 0.8, meaning it's delivering better returns per unit of downside risk you're taking. In plain English, here's the Sortino ratio in plain English. Think of a storm brewing on the horizon. Sortino only cares about the downpours, not the sunshine. CGGR handled those storms better, keeping losses smaller when things got rough. But hold on a second. CGGR's Sortino of 1.0 shows it protects your portfolio when markets drop. That's where real damage happens to your wealth. Let's unpack this a bit. All right, time to weigh in. Who's taking this battle? Drop your vote in the comments. Here's the key takeaway. IUSG's 0.8. Sortino reveals weaker downside protection. You're giving back more gains when markets get choppy and investors panic. Now let's flip the script. CGGR's 29% drop seems manageable until you see IUSG fell 32%. Both funds test your nerves during market crashes. But there's a catch. IUSG's worst crash was brutal. A 32% drop turns your 100,000 into just 68,000 overnight. In plain English, maximum drawdown is like riding a roller coaster. IUSG's track dropped 3 percentage points lower than the other fund. That deeper plunge? It tests your nerves harder when markets crash. Now let's shift gears and look at CGGR's 29% drop is painful. But beating IUSG's drawdown means your portfolio kept more wealth when markets tanked. But here's where it gets interesting. CGGR bounced back 3 months faster than IUSG. That's 91 fewer days watching your money stay underwater during recovery. Let's zoom in on this. Over 16 months underwater before breaking even. That's a long time watching your money stuck in recovery mode. In plain English, recovery time matters just as much as returns. CGGR climbed back to break even 91 days faster than its competitor, like watching the sun rise 3 months earlier after a long, brutal winter. Here's where the story takes a turn. CGGR returned to break even in just over a year. That's the kind of quick recovery that keeps your long-term returns alive. Let's break this down further. Over the past 3 years, both funds showed nearly identical pain tolerance. CGGR down 23%, IUSG down 22%. Practically twins in downturn protection. But here's where it gets interesting. Just a 1% difference in recent drawdowns. Both funds weathered the storm pretty much identically here, folks. Now for the real question. Recovery time's nearly identical here. CGGR bounced back in 79 days. IUSG in 77. Basically neck and neck. Let's dig into the details. CGGR is delivering stronger risk-adjusted returns with that 0.7 Sharpe ratio, while IUSG is telling a rougher story, crashing 32% and taking over 500 days to recover. One's playing defense, the other got knocked down hard. In plain English, think of recent drawdowns like a seesaw. When both funds dropped similar amounts, they balanced out evenly. It's the matched losses that tell you they're moving in lockstep during downturns. Now let's put this in perspective. IUSG charges just 0.04% annually, while CGGR is 0.39%, is nearly 10 times higher. That difference compounds over decades. But wait, there's more to this story. IUSG's rock bottom 0.04% expense ratio means you'll pay just $40 annually on a $100,000 investment. Basically nothing. Here's the thing though. CGGR is charging you nearly 10 times more at 0.39%. That's $390 yearly on every $100,000 invested here. In plain English, here's how expense ratios work. IUSG grabs pocket change from your couch, while CGGR pulls a few bills from your wallet. Both are small costs, but one definitely stings more. Now here's where it gets tricky. That 0.35% fee gap compounds ruthlessly over 20 years, forcing CGGR to outperform significantly just to break even. But that's not the whole picture. CGGR is betting on just 105 stocks, while IUSG spreads across 463. That's way more concentration risk for bigger swings either way. Let's see how this plays out. IUSG's 463 holdings mean you're spreading risk so widely that one company tanking barely touches your overall returns. In plain English, IUSG is spreading risk across 463 holdings, while CGGR concentrates into just 105. It's the classic egg basket dilemma. Fewer baskets mean one bad pick hits way harder. Now, let's connect the dots. CGGR holds just 105 stocks, meaning each position packs a punch. Concentration amplifies both your wins and your losses here. But hold on a second. IUSG packs 66% into megacaps, while CGGR spreads it out at 49%. That's a massive concentration difference you'll feel. Let's unpack this a bit. IUSG loads up on megacaps, 2/3 in giant companies. That's betting stability wins, but you're missing smaller opportunities here. In plain English, IUSG is built on megacap giants, stable but slower growth. CGGR mixes in smaller companies that swing harder but can climb faster. It's like construction rising, solid foundations versus riskier floors with bigger upside potential. Now let's flip the script. CGGR keeps things balanced. Megacaps get 49%, leaving the other half for mid and small cap opportunities to shine through. But there's a catch. IUSG is leaning hard into tech at 48%. That's nearly half the fund. CGGR is more balanced at 33%. Let's get into the weeds here. IUSG is almost half tech at 48%. Your returns live or die by how those tech stocks perform. In plain English, IUSG's tech-heavy tilt acts like a seesaw. When tech stocks rocket, your returns soar. But when tech tumbles, expect a bruising fall. It's all about that balance. But here's where it gets interesting. CGGR keeps tech at 33%. Meaningful exposure without letting one sector dominate your entire portfolio when trouble hits. Let's zoom in on this. CGGR is cheaper at 23.3 versus IUSG's 26.5. You're paying less for every dollar of earnings you get. Now let's shift gears and look at CGGR's trading at a PE of 23.3. You're paying less per dollar of earnings, leaving plenty of room for upside. In plain English, CGGR's stocks deliver better grades for their price tags, while IUSG's holdings charge premium tuition for similar performance. It's like choosing between two schools with identical report cards. One just costs way more. Let's break this down further. IUSG is trading at a 26.5 PE ratio. You're paying a premium price, and that means there's less room for mistakes here. So here's the bottom line. CGGR wins on recent performance and value, while IUSG takes long-term returns and diversification. In plain English, think race cars. CGGR is your turbocharged sports car, accelerating faster lately but burning more fuel. IUSG, that's the reliable sedan cruising efficiently for the long haul. Your destination picks your ride. Let's dig into the details. CGGR targets concentrated growth seekers who will accept higher fees for active picks, and recent momentum's backing this bet up nicely. Here's where things get revealing. For long-term investors prioritizing low costs and broad diversification, IUSG emerges as the clear winner. Your time horizon ultimately determines the champion. Now let's put this in perspective. The real winner, it depends on you, what you're chasing, and how much volatility you can stomach without losing sleep. In plain English, there's no universal winner here. CGGR sprints ahead in short races, while IUSG dominates the marathon. Your investment timeline determines which one crosses the finish line first for you. Here's the thing though, why pick one when you can blend both? A 50-50 split gives you CGGR's momentum, with IUSG's stability as your safety net. Let's take a closer look. CGGRs for concentrated bets with higher fees, while IUSG offers broad diversification at lower costs. Pick what matches your investment style. In plain English, here's your road trip decision. CGGRs, the scenic mountain route with sharper turns and higher fees, while IUSGs, the efficient highway at lower cost. Your comfort with curves and budget, that's what determines your best path. Here's the thing though, standard legal disclaimers here. Do your own research and consult professionals before investing. Let's see how this plays out. That's a wrap on our ETF breakdown. Hit subscribe if you want more data-driven analysis dropping into your feed weekly.